Big takeaway here is like, I knew of this and have done this in the States. Didn't know people were doing it here. Didn't know that it was really an option. But this could be, I mean, if you drop your interest rate even more, you could afford even more. Like,
difference in me paying $250,000 for a half point, right? So 50 bips, let's say.
Yeah.
And that makes me cash flow $5,000 a month versus break even.
We were just on the phone with a mortgage broker talking about this, and like, this can make a monumental difference in how much somebody can afford, right? I'm always correcting them. I don't care about the monthly payment. What are you charging me?
Yeah.
Welcome back to REI Hot Seat. I've got Jacob Campagnaro here, and today we're talking about mortgage buydowns, what's going on in the market, a little bit of an update.
Yeah.
Yeah.
And then we're going to be back at you guys next week with a
deal,
another very interesting deal. But wanted to talk about this.
Well, mortgage buydowns is something I'm familiar with from the broker world. You can do it for residential mortgages, but you brought it up to me that it's actually a tool for the investor's toolkit for commercial buyers. Yeah. Commercial blenders will allow you to buy the rate down. You want to explain that a bit?
Yeah. So what do the inner workings look like? I don't know. We got to get a broker on board.
Why don't we just say why you would want to do it?
Yeah.
And like, explain the context. Who's buying it down? So the borrower, are buying your own rate down?
Correct. So what we've personally done, and why I'm talking about this is because we've done this on a deal. And essentially what's happened is, you can do it one of two ways. And I've actually seen, let me just backpedal here. I've actually seen a number of listings, Andrew, in recently that they've actually advertised that in the MLS listing or in the brochure if it's off market, where they said, hey, rate buy down available, or like, we'll buy down the rate. So essentially, this is a tool that somebody can use to, let's say they can't give a VTB. Right? Hypothetically, Andrew, you're the seller. You want to sell me your property at market dollar, but you're leveraged, right? So you can't give me a VTB. So that kind of cuts that conversation out. So now you're sitting here going, well, I need $3 million to sell my property, $5 million to sell my property. But the interest rates, your property won't cash flow with the current interest rates, and I won't get the loan to value I need. So that's where you can say as a seller. So this is kind of scenario one. So you as the seller can actually, with the financing, say, I'll buy down the rate. So essentially, you'll pay interest to buy my rate down, allowing me, so literally buying the interest rate down, allowing me to, one, get a higher loan to value, right? Yeah, and two, to cash flow.
Well, the big thing, you're going to want to cover that debt coverage ratio, right? So say hypothetically, I've got a property at, I want to sell it for $2 million. I got this in the spreadsheet here. So hypothetically, want to sell a property for $2 million. Okay. And the debt coverage ratio is coming out at 1.03. I don't have a screen share going, but just follow along. So 1.03.
And let's say we're doing CMHC MLI Select in this scenario, because this is actually what we've done in the past.
Okay, so if it's
we need a 1.1.
So you need a 1.1. What's your amortization going to be on the MLI Select?
It's going to be a 45 year.
Okay, so let's do 45 year. At what percentage interest rate would MLI Select be at normally?
Right now, if you were to get it, you're probably sitting somewhere around 5.
5. Okay, so if you're around 5 right now, let's just look at this deal. So I'm going to adjust the price. Yeah. MLI Select is going to give you how much? Maximum 85% or maybe 90?
90, but it's debt service on 1.1, right? So you gotta play around with that.
Yeah. Okay. So at 90, I have some random numbers in here from a deal I evaluated before.
Sure.
So at $2 million, 90% loan to value would be $1.8 million. 45 year AM, 5%. That's an $8,300 payment. That works out to be a debt coverage ratio of 1.08. So there's an example where it wouldn't take that much to get down.
Yeah, and so this is like in this example, it may work, it may not work, Andrew. But hypothetically, let's go through it and say.
So let's say we go to 4.85%. Now it's 1.1. So if we could drop the interest rate down 15 basis points, give me an idea of what 15 basis points costs to buy down on a $1.8 million mortgage. Ballpark it.
Rough calculations, just because I don't have all the math here, but it would be roughly about the interest of the term or slightly less.
Okay, yeah, and I actually had run that number, so I just programmed in, if we're buying down 15 basis points, I put that into my spreadsheet as the interest rate, and then I just calculated what's the 60-month cost of interest, which worked out to be about $12,700. So on this 1.8 million, $12,700. And we were just on the phone with a mortgage broker talking about this, and like this can make a monumental difference in how much somebody can afford, right?
I'm curious in your spread chart here, Andrew, let's actually calculate whether that makes sense for this particular deal. So what would the delta be in the loan to value if you don't hit that 1-1, right?
Let's run it because okay, so if we were still at the 5%, we're at a 1.08 debt coverage ratio. So at 90%, we can't meet the requirement. So we have to start dropping our loan to value down. So do we go to 88%? Yeah, we have to go down to 88% in order to qualify. So we have to drop $40,000 off the loan amount.
Right.
So instead of dropping $40,000 off the loan amount, you could just pay 12 and get the full loan amount.
Yeah.
So there is.
It's a pretty simple version of it.
You're net $28,000 more in your pocket on that example.
Yeah.
But this could be, I mean, if you drop your interest rate even more, you could afford even more. Like let's say hypothetically we buy the rate down double that amount. So hypothetically,
on this scenario, we'd be capping out on the LTV
at 90.
Yeah,
unless you can get the 95 approved.
Sure,
it's rare. So say hypothetically you could go to 95 and we go all the way down to 4.7. Now we can keep squeaking that loan to value up. Maybe we can go up to 92%. And we can go to 92%. So now for an extra 12 grand, we can get an extra 40 on the loan amount.
Yeah.
So that's just in this scenario with this relative buy down.
And this is pretty like small stuff.
Small stuff.
Right? You can look at deals, for example, you can look at deals upwards of like a $500,000 buy down. Right?
Yeah. So, and again, you might look at it and it's not like it's money lost. It's almost like you're prepaying the interest of your term. If you know you're going to keep the building 5 years anyway, you're basically just prepaying some of the interest.
And here's the thing, right? If that's the difference between you cash flowing for 5 years or not cash flowing for 5 years, Andrew, like, find a way to make that work, right? Like, obviously speak with your mortgage brokers about this and how to calculate this stuff. I'm not saying this is set in stone. Every bank's different. Every lender's different. So I have to say that. But hypothetically, okay, so do I go out and I raise that money to buy the rate down, right? And then you can look at, okay, well, if the difference of me paying $250,000 for a half point, right? So 50 bips, let's say.
Yeah.
And that makes me cash flow $5,000 a month versus break even.
Yeah.
Right. Is that now covering the interest payment for that loan? Like, so maybe not the best way to go about it, but what I'm trying to get at is
you're saying, does it make a difference in cash flow?
You can get creative with this, and it would make a difference in cash flow, Andrew, because if you're buying your rate down, let's say a whole percent.
Yeah.
Right. A whole percent on that deal.
Well,
now your debt service is through the roof. Don't worry about the 1-1. Let's say we hit the 95 and drop your rate by a whole point. How does that look?
Well, why don't we just look at this? So I have 667. So we'll use this existing example. So 667. Okay. 79 is the cash flow on this deal at the full 5%, assuming you could cover with the debt coverage ratio, which you can't, but let's just say hypothetically it satisfied that requirement of 1.1.
Okay.
We have 667, 79 as the cash flow. And if we drop it by the 15 basis points, so go down to 4.85% interest rate. So, you invest that 12 grand. Now the cash flow goes up to 874 or 847.67.
Right.
So the cash flow is different by $179. So in 1 year, what's that look like? So what's your ROI from a cash flow standpoint? So you're going to get an extra $2,158 in cash flow over the year for a $12,700 investment. And that's a ballpark investment. It's not actually that much, but your cash on cash return for that investment, you think it's good?
What was it again?
2,156 on a 12,700 investment. Big.
Yeah.
It's 16.9% cash on cash on that decision. So I decide to put in $2,000.
Sorry,
I get an extra. I get almost 17% cash on cash for that decision.
Yeah. So I'd make that decision.
Yeah, for a lot of people, they're gonna, hey, I can tweak my cash flow. I can boost it up a little bit by buying down the rate.
Yeah.
And conversely, how is that different from just putting down more on your mortgage? So what if you put an extra? So instead, we'll go like 89% loan to value, which is about $12,000 less.
Yep.
Your cash flow would be 760. So not as high as the 847. So you make more cash flow by buying down the rate than you do by just putting more principal down.
And here's the thing, guys, right? Like it's going to boil down to each case is going to be so individual, looked at individually, and you have to make those decisions on your particular deal.
Yeah. The big reason is to do this was this can make deals work.
Yes.
And it can juice your cash flow in a market where cash flows suck.
And so, I gave an example of a seller looking to do this, Andrew. Yeah. So, right, okay, I want to sell my building for X and I can't give a VTB and I'm kind of leveraged. Okay, so I'll buy down the rate. Alternatively.
So think about putting right in your ad, we'll buy down your rate to 3%. Like if you say that to somebody, now as a seller, you're thinking it's going to cost me $500,000 or something on my building to do that. Yeah. But now I can get $1 million more, less the 5, so I get 500 more than I would otherwise.
Yep.
And the appraisers, we know what Ontario's like. Appraisers tend to just support whatever the value is. I actually offered this in Florida. We offered to buy down rates. No one ended up taking us up on this, but it was something that was common down there.
Understood, or what do you think it was?
No, it was understood. Maybe not by everyone, but my realtor understood it, and he's like, "Why don't we just do this? Some other people are doing that." And people had conversations with us because at the end of the day, they're looking at what their monthly payment is. So if you can find a way to make their monthly payment work, it's just like you go and sit down and buy a new car. They don't talk in terms of the total cost of the car.
Yeah.
We can get you down to this monthly payment. I'm always correcting them. I don't care about the monthly payment. What are you charging me? What's the total debt? I know you're the opposite.
I'm the opposite. Like, I was going to say,
what's the monthly payment?
Well, I always look at it and go, listen, you got to look at the whole picture, but I like to look at the monthly payments.
Yeah, right? No, that's fair. No, in that they do matter. Don't get me wrong. Yeah. They do matter, and everybody's got a different look there. I know how they like to sneak all that stuff in. Oh, we'll just back end that, build that into your loan. Yeah.
My argument's always trying to get that interest rate down when I'm buying cars. Yeah, right. That's my biggest thing. It's not even the monthly payment. It's okay. How do you get the interest rate down?
Yeah,
right. Loyalty program. Give me that. Give me this.
Yeah, what are you gonna do for me? Yeah, so for sure.
That's the key is getting that rate down.
So big takeaway here is like this is. I knew of this and have done this in the States. Didn't know people were doing it here. Didn't know that it was really an option because, I mean, my first thought was, who are you going to go to? Like, I knew through a broker you could buy it down, but you're saying right at the lender will allow you to buy it down as the borrower. So that's new to me. I think that's really, really cool and another useful tool. And going in the theme of the last couple of weeks, like I think, don't look now, but I think Ontario's becoming poised with opportunity. It's getting to the point where prices have gone down and down and down. No one's paying attention to Ontario right now, and perfect time to strike.
There's some decent opportunity coming about. There really is, and there's a lot of mixed feelings about it. But I truly believe that if you're patient and you can find wait and look for those opportunities, like it's not time to be making brash decisions.
No, in the micro, you have to assess every deal.
Yep.
You have to make sure that deal works.
Yep.
But this is the perfect time to have conversations.
Yes.
Have an extended due diligence period. Negotiate with the seller because odds are, if not everybody's talking to them and their phone's not ringing, they're going to listen to you.
And here's the thing, right? And it's like, so that's, it bothers me so much when realtors try to push the quick closing, quick deals, like this needs to be quick. And it's like, guys, like you're not in tune with the market. Like, right? What I don't get it. Like you're going to hurt your value because you want something so quick. And it's like, I get you want security, but like
so the realtors are still pushing for
you're still trying to push for quick close.
Everybody wants that. And I know as a seller, I've been a seller a lot lately of all the stuff in Florida and
quick is good.
You want that, especially in a down there, like nothing's done until it's done. Like their loans are contingent all the way up till like whenever. It feels like things get drawn out. Here, it's not that bad. Like on commercial, what do you normally like 30 to 60 days for due diligence?
Yeah, like you're usually 30. Like the short end is 30 and 30, right?
30 to due diligence, 30 to close.
Yeah,
and that's pretty darn quick.
That's pretty darn quick when you're thinking about ESA, BCA appraisal.
Yeah,
right there. That's
so environmental conditional, building condition analysis, and appraisal. Those are all very intensive reports. They take time.
That could be 30 days right there. Yeah. And then once you get those, then you send it to the lender, and then the lender's got to start reviewing and underwriting it and going through the process.
I mean, I think 30 for financing is tight.
Especially in this market, like it's so important to get a commitment within your conditional period.
Yeah.
Historically, it's been, can I get an LOI? Can I get a term sheet?
No, you need a commitment. Yeah.
Right now, you need a commitment because there's been too many scenarios where the bonds fluctuate overnight and now all of a sudden
you don't qualify.
You're and commitments are conditional on rates as well, but you can do a rate lock, you can do a rate buy down. There's a lot of different things. So anyways, hopefully this is either new information or it's information that we've clarified for somebody, and that they can go out and use this to acquire real estate. I think it's a great tool. It's something I never, like, I knew it existed, but similar to yourself, I never really focused on it until this year. And now all of a sudden I see how much of an impact this is making.
It's going to be cool. The next little bit, it's sad for, certain sellers and a lot of things, but I mean, the way people creatively make deals is going to be really cool to see over the next year or so. All right, that's all the time we have for today. If you're enjoying yourself, if you're enjoying this content, please share it with somebody, and please do all those things that get this out there. And we'll see you again.
Go to the
link
below.
Yeah, the link below. If you want to get in touch with Jacob and have him help you in your real estate journey, you can do that through the link in the show notes.
Sweet. Okay. Thanks, Andrew.
Thank you.